Hey, welcome to the video. My name's Alex and this is Accountancy Basics. This episode, which is the 6th in our series, is going to cover accruals basis accounting. If you've been liking and enjoying the videos, drop the video a like, subscribe and get involved in the comments down below. So let's get into it. So in this video, we're going to cover what is accruals based accounting, why do we and how do we use it. We're also going to touch on a bit of cash accounting as well. We're going to explain what it is and the differences. It's probably going to be a bit of a shorter video because I just want to dedicate a video to talking about accruals principle of accounting, because it is probably one of the most important things that you can learn about accountancy, because it underlies the complete basis of how we prepare financials, how we input data, how we record data, and how we can tell a set of financial statements are correct or not. So first of all, what is accruals basis accounting? So accruals basis accounting is essentially the method of recording expenses and revenue in the period that they relate to. Now, this may sound really obvious, but let me give you an example of how this can be used in practice. So say you've got rent and you get invoiced rent once a year. Now, if you input your invoice into the system, you'll have your invoice date, which will be the 1st of January. You'll have the expense of however much your rent is. Say it's £1,000 a month, so it's £12,000. What you are going to do is when you put in that invoice in January, because the invoice is dated on the 1st of January, you're going to have £12,000 showing as an expense in your rent. Now obviously you're not going to receive any more rent invoices because you've already been invoiced for the year. And when you look at a monthly profit and loss, so you see your January expenses, your February expenses, your March expenses, you're going to have one massive cost in your January and nothing in your February and March. What accruals accounting is essentially making sure that you record an allocation to January, an allocation to February and an allocation to March, etc. so that you can see the actual cost of rent for January, which is going to be £1,000. I'll get into how we do this a little bit later in the video. So it sounds pretty obvious, but why do we need to do it? Now there are a few reasons why we do it. The first reason is we want to ensure that all of our revenue that we show in a period has the corresponding expenses in the same month. Now obviously if you run a factory, we'll go back to our example of rent. If you generate X amount of income from a factory, you want to make sure that you've got 1 month of rent in there because you've had to pay 1 month's rent to generate this income. You haven't paid 12 months rent to generate 1 month's worth of income. You've paid 12 months of rent to generate 12 months of income. So you need to split it out evenly because you only want to allocate the expense in the period it relates to. It has nothing to do with the invoice date. This is pretty much the core reason why we do accruals accounting, but a knock-on effect is it also gets rid of the distortion from invoice timing. So, you know, using the rent example again, if you get 12 months of a cost up front in 1 month, you don't want to record all 12 months in 1 month. You want it split out across all of the months. Also, you might get billed in arrears, so you do something and then you're billed for it. So for example, your phone contract, you might get billed for your phone usage in June. It might be dated in July because they've had to collect all of that phone usage data and then they send you a bill which is raised in July. Now you want to show that phone cost in June, so you need to use accruals basis accounting to show the telephone cost in June rather than July. So I think now is probably a good time to talk about cash accounting, and it is pretty much what it says on the tin. It's when you pay it out. So you get a rent invoice, you pay all 12 months in one go, you recognise that as a cost in the profit and loss when the cash goes out. That's essentially all that cash accounting is. Now, in my experience, I haven't ever seen a set of accounts done on a cash accounting basis because it doesn't really give you a good picture of what's actually going on. However, you can prepare VAT returns on a cash basis, and essentially what this does is you only pay across the VAT for invoices you've received rather than invoices you've actually issued. Now that probably won't make sense to you right now, but I'm going to do another video later on in the series about VAT and the different ways that you can prepare it. So stay tuned for that. But for the purpose of this video, just understand that cash accounting is where you record the cost when you physically pay the cash out rather than what the cost actually relates to, what period it relates to. Finally, and probably the most important one, is how do we do it? Now, if you get a bill and it's dated on a certain date, there's no way around it. You have to put in the bill at the date that it's showing. So you're probably wondering, how do I show the cost in a different period if I'm putting it in at the invoice date? Well, it's simple, but not really. Basically, we use something called accruals and prepayments for expenses, and we do deferred income and accrued income for our income. Now again, I'm gonna do a video on accruals and prepayments and another one for accrued income and deferred income. These are a little bit more advanced. I didn't really deal with deferred income until quite a way through my career. It's not that it's hard, but it's rare, really. And the more you use it and the more you get used to using these accruals, prepayments, deferred income, accrued income, the more it's gonna make sense. But let's leave it there for now. But essentially, we use those tools to move costs around so that we ensure that there is the correct amount of income and expenses in the right period, and so that we can get some really accurate financial reporting. So that's it. If you enjoyed the video, give it a thumbs up, subscribe, and if you've got any questions, leave them in the comments down below and I'll reply. Otherwise, I'll see you in the next one.